Listen up. If you earn over the student loan threshold in New Zealand, 12 cents of every extra dollar you make is automatically pulled to pay your loan. For a lot of people, that deduction just happens in the background. But here's the catch. If your tax code isn't set right, if you've got a second job, or if you're thinking of moving overseas, you can either pay more than you need to, or not enough, and get stung later. Today, in plain English, I'll show you the exact thresholds, how the 12% works on real paychecks, the traps people fall into, and the smartest ways to pay your loan down without wrecking your cash flow. First, the golden rule. Your student loan repayment from salary or wages is 12% of your income above the threshold. If you're in New Zealand for tax purposes and earning wages, your loan is interest-free. So the 12% is simply a repayment, not interest. That interest-free while NZ-based detail matters for your strategy later. But the 12% itself doesn't kick in until you cross the threshold. For the 2026 tax year, that's 1 April 2025 to 31st of March 2026, the annual threshold is $24,128. Inland Revenue also converts that into per pay amounts so payroll can get it right. $464 if you're paid weekly, $928 fortnightly, $1,856 every 4 weeks, or about $2,010.66 monthly. Remember those numbers because they explain almost every payslip. Let's put real numbers on it. Imagine you're paid weekly and your gross pay is $600. The weekly threshold is $464. So only the portion over that, $136, is subject to student loan deductions. 12% of $136 is $16.32. That's the amount you'd see taken for the loan in that week. If a different week you earn $1,200, the over-threshold portion would be $1,200 minus $464, which is $736. 12% of $736 is $88.32. These examples aren't guesses. This is exactly how Inland Revenue models it. Now, none of this happens properly unless your tax code has the SL suffix. If you have a student loan and you're earning salary or wages, you must use a code like MSL for your main job. That SL flags to payroll that student loan deductions are required. Without SL, under-deductions can build up quietly. When IRD catches it, they send your employer an extra deduction notice to claw back the shortfall, typically an additional 5% on the relevant income until you're caught up. Fix the code now, and you avoid the scramble later. Let's talk second jobs because this surprises people. The threshold only applies to your main job. On a secondary job, like a weekend shift or evening gig, the law assumes you already used the threshold in your main job. So in the second job, 12% comes off every dollar from $1. If you earn $200 in that second job in a week, the student loan repayment is simply $24. That can feel harsh if your main job pays under the threshold and the second job is just topping up. The fix is a special deduction rate. You apply in myIR, tell IRD what you expect to earn across your jobs, and they can reduce the deduction rate in the secondary job so you don't overpay. It's not automatic, you need to apply, and approvals run by quarter. So set a reminder to renew if your situation hasn't changed. If you're self-employed, a contractor, or getting other income outside payroll, you settle up at year-end. The rule of thumb, if your adjusted net income is $500 or more, and you're $500 or more over the annual threshold, expect an end-of-year student loan bill. To avoid a nasty surprise, consider interim payments through the year. There's even a key date of 15 January for interim payments that count toward your end-of-year obligation. This is especially important for freelancers with lumpy income. Before we hit the overseas rules, here's a quick checklist to make sure your New Zealand payroll is clean. 1. Confirm your code has SL. 2. If you have 2 jobs and your main job is under the threshold, consider applying for a special deduction rate for the second. 3. If you're still studying and sometimes go over the weekly threshold, but will end up under the annual threshold, you can apply for a repayment deduction exemption. Again, through myIR, so you aren't having repayments carved out of holiday or summer work that technically shouldn't push you over for the full year. And 4. Log into myIR and keep an eye on your balance and deductions every few months. Under and over deductions are much easier to fix the earlier you spot them. Okay, going overseas flips the table. After roughly 6 months away from New Zealand, you become overseas based. And from the day after you left NZ, interest starts to apply to your loan. The current annual interest rate is 4.9%. If you miss payments, late payment interest can push the effective rate you're charged higher, up to 8.9% in total. That is a big deal for your strategy. So while you're NZ-based, the loan is interest-free. Once you become overseas-based, interest accrues daily and is added annually. That alone is reason to plan ahead if a move is on your horizon. For overseas-based borrowers, your minimum repayments aren't tied to your income anymore. They're tied to your loan balance. Inland Revenue issues an assessment that splits your obligation across 2 dates, 30 September and 31st of March. For example, if your balance is in the lower bands, you might owe $500 at each date for a total of $1,000 that year. Higher balances require higher minimums, up to $2,500 in each half for big loans. If you're close to moving overseas, one smart move is to make a lump sum before you leave. Knocking your balance under a band can reduce your minimum repayments overseas and curb interest accumulation. There's also the option of a temporary repayment suspension for up to 12 months when you first head offshore. It buys you time, but interest still accrues. When the suspension ends, you pick up repayments again on the same 30 September and 31st of March cycle. If you're likely to struggle, smaller automatic payments monthly can keep you on track and avoid late payment interest. The theme with overseas loans is simple: plan before you board the plane. Now let's stitch this together into a few quick scenarios. If you earn $65,000 in a single NZ job and your tax code is MSL, payroll will handle deductions correctly as long as that SL is present. You could add small voluntary top-ups if you want to clear the loan faster. But because your loan is interest-free while NZ-based, you might get a better return knocking out any high-interest credit card first. That is rational math. Interest-free versus 20% on a card is not a close call. If you're juggling 2 jobs and getting frustrated that your second job is taking 12% from the first dollar, apply for a special deduction rate so the total across your jobs better matches what you'll actually owe for the year. And if you're a freelancer with a surge month, don't wait. Make an interim payment in myIR so you don't get crushed at year-end. What about over and under deductions? If IRD spots a shortfall, they can instruct your employer to make extra deductions. Think of it as a temporary 5% catch-up on the income that needs it, layered on top of the normal 12% rules. If you accidentally overpay by a significant amount, $70 or more in a month due to payroll over-deducting, you may be able to get a refund. But if the over-deduction happened because you gave the wrong tax code, that's usually considered final. Moral of the story: keep your tax code updated and check your payslips. Let's zoom in on some smart paydown tactics that actually move the needle. Number 1. If you're NZ-based and you have any debt charging interest, credit cards, buy now, pay later, personal loans, prioritize those first. Your student loan is interest-free while you're here. Throwing extra cash at it while carrying a 20% card is like bailing a boat while drilling holes in the bottom. Keep the standard 12% loan deductions flowing via payroll and aim your extra dollars where interest is hurting you most. Number 2. Use micro top-ups to build momentum. Inside myIR, you can set small voluntary payments, say $10 or $20 a week, on top of payroll deductions. It won't destroy your budget, but over a year, you'll carve hundreds off the balance. That matters because every dollar you remove now is a dollar that can't start attracting interest if you go overseas later. It's like preloading your future. Number 3. If you're planning to leave New Zealand for more than 6 months, consider a pre-departure lump sum. Even a modest amount can nudge you into a lower minimum repayment band overseas, and it reduces the base that 4.9% interest compounding can bite into. Pair that with setting up automatic payments for the 30 September and 31st of March obligations, and you'll avoid late payment interest. Think of it as de-risking your time away. Number 4. If you have 2 jobs and the secondary job is skimming 12% from $1, even though your main job earnings sit under the threshold, apply for that special deduction rate. It's a form in myIR. It lasts to the end of the quarter, and it's designed specifically to stop people in your situation from over-deducting. Renew it if your situation stays the same. If things change, hours go up, one job ends, tell IRD so they can adjust the rate. Number 5. If you're still studying and your annual income will land at $24,128, but a few weeks push you over $464 because of holiday work, apply for the repayment deduction exemption in myIR. It can run from the day you apply through to 31st March and even cover breaks between semesters. That keeps short-term spikes from draining your pay when you don't actually owe for the year as a whole. Again, you need to opt in. This won't happen automatically. Number 6. Watch for the extra deduction notice if IRD flags an underpayment. Say your SL code was missing for part of the year. That extra 5% is not a penalty, it's a catch-up tool. You can embrace it to clean up quickly, or you can make a voluntary payment to reduce how long the extra 5% sticks around. Either way, act. Ignoring it only delays the inevitable. Number 7. If cash flow is genuinely tight, go into myIR and look at reduced or tailored deductions. IRD can approve a reduced deduction rate when your payroll deductions would otherwise create hardship, and they have processes for people who are temporarily struggling. Especially relevant if you're overseas and need to negotiate repayment amounts. The point is, don't disappear. Engage early and set something sustainable. A quick word on mindset. For NZ-based borrowers, the absence of interest can make the loan feel not urgent. That's fine if you have higher interest problems to solve first. But once those are handled, it's okay to get aggressive with the loan, especially if a future move overseas is likely. Think in milestones. Get it under a band, then under 10K, then gone. If you're overseas, consistency beats heroics. Set up automatic payments for the 2 due dates the moment your assessment arrives, and consider monthly installments so September and March don't hit like a brick. Let's finish with a rapid-fire recap you can live by. In New Zealand, your loan deductions are 12% of what you earn over $24,128 per year, or over $464 a week, provided your tax code includes SL. Secondary jobs deduct 12% from the first dollar unless you apply for a special deduction rate. Self-employed, budget for an end-of-year repayment and use interim payments to avoid a crunch. If you move overseas and become overseas-based, interest at 4.9% kicks in, and your minimum repayments are set by your loan balance, due around 30 September and 31st of March. Smart moves: fix your SL code, keep an eye on myIR, apply for special rates or exemptions when they fit, prioritize higher interest debts, and plan a lump sum before going overseas if you're close to a band. That's the playbook. If this helped, do me a favor. Like this video so more Kiwis see it, subscribe for more Clear Money explainers, and drop a comment with your situation. Single job, 2 jobs, freelancing, or moving overseas. I'll reply with a short, personalized paydown plan you can use this week.